Welcome to a super simple introduction to taxes, Part 2, Tax Deductions. This is Professor Russell James. Charitable gifts and other expenditures may generate income tax deductions. Consequently, it is important to know how to calculate the effects of such deductions. An income tax deduction reduces taxable income. The value of a reduction in taxable income is the tax owed at the original taxable income less the tax owed at the reduced taxable income. Thus, understanding the value of a tax deduction, such as a charitable tax deduction, requires the ability to calculate taxes owed at various levels of taxable income. And this requires understanding how tax brackets apply to taxable income. Tax deductions reduce taxable income. For example, a taxpayer with taxable income of $10,000 who then takes a $1,000 additional deduction will have $9,000 of taxable income. A tax deduction has the same effect on taxable income regardless of the amount of taxable income earned by the taxpayer. Whether the taxpayer's taxable income is $10,000, $100,000, or $10 million, an additional $1,000 deduction will reduce the taxpayer's taxable income by exactly $1,000. However, the value of the $1,000 deduction may vary greatly depending upon the taxpayer's taxable income. A $1,000 deduction is not worth $1,000. The deduction amount indicates the amount by which taxable income will be reduced, but its value depends upon the tax rate of the taxpayer. Just because a $1,000 deduction reduces taxable income by $1,000 at all income levels does not mean it is worth the same at all income levels. Often the value of the tax deduction is the amount of the tax deduction multiplied by the taxpayer's highest tax bracket. So a $1,000 deduction is worth $100 to a taxpayer in the 10% bracket. That same tax deduction is usually worth $370 to a taxpayer in the 37% bracket. This difference in value helps to explain why charitable tax deductions may be more interesting to those with higher incomes. Charitable income tax deductions are an itemized income tax deduction. Other examples of itemized income tax deductions include the mortgage interest deduction, deductions for medical expenses greater than a set percentage of adjusted gross income, and deductions for state and local taxes up to $10,000. In order to use itemized deductions, a taxpayer must give up the standard deduction. So a taxpayer who takes the standard deduction cannot use any charitable income tax deductions. An itemized tax deduction, such as a charitable tax deduction, may in fact be worth nothing to a taxpayer. Consider the example of a single donor who made $4,000 of deductible charitable gifts in 2018, but had no other itemized deductions. This donor would face the choice of using either $4,000 of itemized deductions or using the $12,000 standard deduction. Obviously, the taxpayer would be better off to take the standard deduction. Consequently, the $4,000 in charitable income tax deductions has no value to this taxpayer. This also helps to explain why charitable deductions tend to be of greater interest to higher income taxpayers. Such taxpayers are more likely to have other itemized deductions, principally the mortgage interest deduction, that are larger than the standard deduction. These itemizers can use the full value of any additional deductions because other deductions have already surpassed the value of the standard deduction. Although the charitable income tax deduction is a common tax benefit of charitable transactions, it is not the only tax benefit. Thus, a good deal of charitable financial planning allows for positive tax consequences, even for those taxpayers who cannot use the charitable income tax deduction. These tax benefits come not through deductions to reported income, but by avoiding or postponing recognition of income in the first place. Thus, it is important to recognize that there is much charitable tax planning available, even for taxpayers who use the standard deduction. For the remainder of this lecture, the examples will assume that taxpayers are already itemizers. In other words, due to other itemized deductions, the taxpayers are assumed to be already foregoing the standard deduction. Consequently, the taxpayers are assumed to use every dollar of any itemized deduction, such as a charitable deduction. As mentioned previously, the value of a tax deduction depends upon the tax rate of the taxpayer. For example, a single taxpayer with $8,000 of taxable income in 2018 would pay $800 in taxes. If the taxpayer were to have received an additional $1,000 deduction, his or her taxable income would have fallen to $7,000, and he or she would have owed $700 in taxes. Thus, the $1,000 deduction would have caused the taxpayer's tax bill to drop by $100. The same tax deduction is worth more to a higher income taxpayer. For example, a single taxpayer with $600,000 of taxable income in 2018 would pay $187,689.50 in taxes. If the taxpayer were to have received an additional $1,000 deduction, his or her taxable income would have fallen to $599,000, and he or she would have owed $187,319.50 in taxes. Thus, the $1,000 deduction would have caused the taxpayer's tax bill to drop by $370. In the prior two cases, the quick way to calculate the value of the deduction would have been to simply multiply the deduction by the taxpayer's marginal tax rate. For example, $1,000 times 10% marginal tax rate equals $100 in the first example, and $1,000 times a 37% marginal tax rate equals $370 in the second example. However, this simple approach does not work if the deduction causes the taxpayer's marginal tax rate to change. In that case, part of the deduction will be valued at the higher tax rate, and part will be valued at the lower tax rate. As an example, consider the value of a $1,000 deduction to a single taxpayer with $10,000 of taxable income in 2018. The taxpayer begins at the 12% marginal tax rate. However, after applying the first $475 of the deduction, the taxpayer now has $9,525 of taxable income and drops into the lower tax bracket. Thus, any further deductions will reduce taxation not at the original 12% rate, but at the lower 10% rate. The first $475 of the deduction reduces taxes at a 12% rate, and the final $525 of the deduction reduces taxes at a 10% rate. The value of the deduction is thus $475 times 12% plus $525 times 10%. That, all added together, equals $109.50. Put another way, a single taxpayer with $10,000 of taxable income in 2018 would pay $1,009.50 in taxes. If the taxpayer were to have received an additional $1,000 deduction, his or her taxable income would have fallen to $9,000, and he or she would have owed $900 in taxes. Thus, the $1,000 deduction would have caused the taxpayer's tax bill to drop by $109.50. This has been a super simple introduction to taxes, Part 2, Tax Deductions. Join us next time for a super simple introduction to taxes, Part 3, Capital Gain, Estate, Gift, and Generation Skipping Taxes.